Hi everyone, welcome to this live show. As usual, I will share with you my views of the market, both technically and fundamentally. So let's start with the macroeconomic calendar as usual. Although, I was thinking right before starting that there's not much in the calendar this week. In fact, it's not much about data, what we are seeing in the market, right? The market is all about politics and political woes, not only in the US and Europe. Of course, what we are witnessing these days, this sudden and strong dollar weakness is mostly due uh, to the unwind of the so-called Trump trade, right? Market was confident that the new U.S. administration was going to pass through the Congress and establish a new growth agenda focusing on rising investment, cutting taxes, right? And that fuel demand for base metals, for example, which were one of the best performers during this past months among equities. It also fueled demand for financials, right? Because of the proposed tax cut, right, in the US. So everyone was happily buying stocks. Everyone was happily buying greenbacks, betting on a brighter future. And all of that all of a sudden reverted when our friend Donald Trump lost, right, his first challenge before Congress as he was unable to pass the Obamacare repeal bill, right, uh, last week. And finally, they pulled it out from Congress because they didn't get enough votes to back it. Another factor, of course, and waiting on the greenback is the fact that the Federal Reserve has in fact offered a rate hike, but that rate hike come with a softer tone for monetary policy for the future, right? We all know that the Fed is likely to rise rates two more times this year, and that's it. So that is largely priced in, and therefore won't be enough to. It has not been enough to back the greenback, right? We all knew that ever since last December, three rate hikes for this 2017 being likely. Anyway, I was checking the macroeconomic calendar, and as I said, there's not much on it for this week. There are a couple of reports that may affect the currencies, but actually, there's no macroeconomic report, at least in the US, that can change or revert the negative tone of the greenback, no matter how good it comes out. Okay, keep that in mind before anything else. Uh, Another thing that I was reading that sounded quite relevant for me, despite it had little showed in the media, is that the German members of the ECB's Governance Council have been pledging for retrieving the aggressive stimulus that the central bank is applying, right? Again, a rising speculation that the ECB may start tapering earlier than 2019, which is what Draghi has said in the past, right? Until the end of his mandate, he would probably maintain the stimulus. Those are his words. Anyway, what I'm trying to say here is that if the ECB starts retreating or retrieving its stimulus, somehow that would be euro supportive. We also know that the Bank of Japan, I guess we discussed it a couple of weeks ago, the Bank of Japan is actually buying less bonds than the usual to keep the yield curve balance, right? The Bank of Japan does not need to buy too many bonds, too much bonds to reach its target. So that is some sort of tapering also going on in Japan, right? And the market is seeing like that. Not sure if it's like it, but it's what the market is seeing. So those factors are also playing against the greenback. Another thing that's going on quite interesting in the market these days is the trigger of the Article 50 by the UK tomorrow. Everyone expecting Theresa May to announce the beginning of the divorce between the UK and the euro area starting tomorrow. In fact, the Article 50 sets little of the Lisbon Treaty, right? Sets little about the process or how they will handle relations from here on. The fact is that pretty much is focused on saying that from now on, Euro area and UK have 2 years to negotiate the conditions of their future relationships, right? Um, the Euro area wants a lot, much more than what the UK is willing to give. I guess that the power is now in the hands of the Euro area because they can uh, ask for certain money or ask for the terminate conditions to keep on trading with UK. So uh, I'm not seeing about a bright future for the pound, but in the short term, I mean tomorrow, this week, the announcement of the beginning of the process should have little effect, right, on the market because the effects are more long term, more to see what happens with the deals, how the deal march, if the UK is forced to pay or not, if economic conditions in the UK deteriorate, if inflation keeps rising, and so on. There are many other factors that won't be seen tomorrow. That's right. Well, that's why I'm trying to say those factors. We are going to see them in a couple of long months, not just 2 or 3, maybe 5 or 6. So pretty much that's the background scenario we are dealing with. Distrust in Trump, speculation that the ECB may begin tapering earlier than expected, and Brexit in the long run hitting pound, right? Anyway, as I said, there's not much in the macroeconomic calendar. I was focusing yesterday in on several Fed speakers, right? We have plenty of them today, also including Yellen, Kaplan, George. You know what? We are not going to add anything new to for the market already new knows about the Fed and the monetary policy. They won't change the scenario brutally, so they will hardly affect the market, right? Unless we start talking about I don't know 4 rate hikes this year or the need of uh, rushing on the pace of hikes or rising rates as soon as next meeting, right? That will be something that could maybe move the dollar into positive territory, but not these usual meetings. The fact is that they will probably pass unnoticed as they have nothing new to add to the markets. Okay, keep that in mind. I do believe that maybe the most important report we are going to see today, right? It's consumer confidence in the U.S. as it's expected to fall, and that will be another stone in the dollar's shoe, right? So beware of that because negative data will weigh much more than positive one when the data is alongside with the trend, right? The trend only tends to accelerate, so beware of that. But if the data is against the trend, it needs to be really, really surprising and shocking to revert the trend. And right now we have a negative dollar trend, and therefore negative data coming from the US will weigh more on the greenback than positive one. Okay. Anyway, as you can see, there's little so far in the week. The macroeconomic calendar in Europe and the UK. As I said, tomorrow, Wednesday, the focus will be the Article 50, the trigger of the Article 50 of the Lisbon Treaty. And maybe I do believe that beyond all another round of Fed speakers, market the most relevant really will be crude oil stocks price because you know crude oil stocks have been increasing wildly in the US alongside with production. So that's offsetting OPEC efforts to deal with lower prices, right? So last week we had a setback in sorry, in the oil the stockpiles rise, right? And they fell a bit or they rise less than expected. I don't remember, but what I'm trying to say here is that if we have another strong reading and another bill in stocks to record highs and that will be probably bad news for oil. Okay, and on Thursday, sentiment in the euro area and inflation in Germany. This is a preliminary reading for March, so it's a bit more relevant than the one we heard a couple of weeks ago, which was a revision of February numbers. Remember, these preliminary readings are pretty much relevant, but they are expected below final February numbers, so really not much of a concern. However, if yearly inflation remains above 2 in both cases, um, in the harmonized with the euro area and in the local one, well, that would be a positive sign for the euro dollar. In the US, will release the final revision of the GDP also. So I'm not expecting too much of this report because, it's the third number we heard about this last quarter of 2016. So actually not a big market mover, not much to take care of. But if we have a big deviation from that 1.9, then that will affect the greenback, at least in the short term, right? Uh, and Japanese inflation, the market does not react hardly to Japan data, but this one is relevant. It will tell us whether the Bank of Japan is closer or farther away from tapering, right? So take a look at it. Anyway, inflation is in negative territory. It has been depressed for years. We're not expecting a big surprise in here, not that. And they are still far away from the 2% to even think that we will get that good surprise. And even though, think about this, we have had, I don't know, 3, 4 years of depressed inflation. If all of a sudden these numbers surprise to the upside and we have, I don't know, 1.5 or something like that, closer to the 2%. Of course, it will be an initially positive figure, right? But the market will quickly revert any of that initial move, right? Because to think about finally stabilizing inflation in Japan, it will take 3 months, 4 months readings, right? Above 1.5. So not just one number, not one number makes the trend. Remember that. Uh, and finally, on Friday, I don't see much to take care of, to be honest, beyond GDP. In the UK, it's also final revision of the last quarter, so really not much to care about. And personal consumption expenditures could be a bit more interesting, but not much more. I would love to see spending rising faster, income rising faster, and we are not expecting any big surprises from those two. Okay, that will be a bit of a dollar supportive, but not enough to revert the trend, as I say. And the Michigan Sentiment Index also will be a bit relevant, okay, but not that much. So that's pretty much the macroeconomic picture. I guess headlines coming from politicians will be doing much more for currencies than anything we can get from Canada, right? Anyway, let's jump to the charts. Um, Pretty much every pair gapped higher at the weekly opening, and as you can see, many of those gaps remain unfilled. I have a rule about gaps, weekly opening gaps, right? And that rule says that if the gap does not get filled in the first 3 hours of trading, uh, it's impossible to predict when it's going to get filled. It could be filled in the same day, in a week, in a month, in a year, or never. So if you are betting on this gap to be closed these days, you are maybe in the wrong side of the market. So beware of that. 3 hours, the first 3 hours of trading after the weekly opening, that's the time to fill the gap. If the gap that does not get filled, then the situation turns to risky. Anyway, uh, Paris trading at its highest for this year. As you can see, we are levels last seen in a spike in December, right? I'm paying a lot of attention to the daily chart because the price is smiling to settle and advance above the 200 exponential moving average. We have been below it for very, very long. right? And my key resistance right now is the 930 region, as it's the 61.8% retracement of the post-US election decline, right? So that's my main bullish target these days. I believe that if we break above it, we can surely go to test 110, right? And that's the match I can see in the euro. If US data continues to disappoint, and on the other hand, we hear much more jawboning coming from the euro area about the possible tapering of easing, well, then the pair will probably go past 110. And I guess 112, I believe 112 is the next probable bullish target. But right now it seems too far away from me. I'm watching this 930 and 110 for this week as probable top. Okay. And towards the downside, well, we have February high at 828. We have the 50% retracement of the decline at 120. And if you take a look at this chart, you will see multiple daily highs in the region. So overall, this is my main support. That means that it will take a clear break, maybe below 790, right? 700, 800, sorry, 800 or 790, to deny the possibility of further gains and see a deeper corrective move, in which case 730 would be the level I will be watching because it has been a huge resistance and it's now for me a big support, uh, and followed by the 700 area. Both are quite close, so this 700, 730 region should contain declines in euro to keep the bullish trend alive, right? And understanding this 150 move, downward move as a correction in the middle of this newborn bullish trend. Okay, so that's the last line for me towards the downside. 700, one the last one towards the upside. It's 110 right now. Okay, and for the pound, another one that's trading at relevant highs, right? Although in January we have a spike up to 27.05. That's the main bullish target. If we surpass this 26.14, which has been Monday high, okay? And that's the level I'm watching. Anyway, pound sounds a bit more risky because it has been a bit unpredictable when it comes to Brexit headlines and how it will react. As I said earlier, I really don't expect that the trigger of the Article 50 will result in a sharp decline in the pair, right? Because it's something that the market already knows, and it's pretty much priced in. And what we are seeing these days, it's not a weakness, but still be cautious about this particular pair. 26.15, 26.60, 27.05 are my main resistance for the upcoming days. And as you can see today, we have the pair testing this Fibonacci support 23. The support is at 25.35. The pair started its decline a couple of pips above it, but anyway, if you can see the forward charts, the 20 simple moving average is nearby, reinforcing the level. So it will take a break below this one to talk about a deeper downward corrective movement towards 24.70 first, right? The level has been quite strong, 24.67 to this region, ahead of 24.45, 24.30, sorry. If the pair loses this last, then I could I could believe that the bearish momentum will likely accelerate. Okay, for the dollar Japanese yen, my key support is 109.90, right, which is the 50% of the November-December rally, okay, the post-US election rally. We are trading at 2015, 2017, bro. I traveled to the past. Lows, this year lows, and not far away from that support. So as I was saying, it's a critical support that if gets broken, could imply another 100, 150 pips decline easily. But because when the dollar Japanese yen gets into a trend, it's hardly uh, pulls back or reverts until it finds the major support or resistance level, right? However, as we discussed in previous meetings, remember I told you that the Japanese yen tends to appreciate in by the end of February and March ahead of the end of the fiscal year. Well, the fiscal year in Japan ends in a couple of days, right? March 21st. So that will be quite noisy for the pair, and after that we could see the dollar recovering by some ground against the yen. But given that the greenback is that weak, seems unlikely the recovery will be strong, right? So anyway, below 109.90, I'm actually expecting further declines. And this region, the former lows in the 1160 area, are for me key, as it will take a recovery above it to deny the bearish extension, right? And anyway, if we surpass this level, I can hardly see the pair surpassing the 14, 113, 113.50 region, right? At least for this week. When it comes to the Australian dollar, things have been quite hard for the Aussie these days, particularly because of the unwind of the Trump trade, right? Copper prices fell, iron ore prices fell, commodities came under pressure. But what I'm seeing today is that despite we have seen some relief in stocks market, right, and stocks recovering in the Asian session, the Aussie is unable to bounce, right? So maybe there's some uh, upward exhaustion in here, right? Sorry. So beware of trying to go long in the Aussie despite ongoing dollar weakness. What I'm seeing in the shorter term, it's or the level I'm watching is the 75.70 price zone, because the price has stalled here multiple times in the past, either up and down. So this is my first support for the upcoming sessions. If the level gives up, then 75.30 is my next bearish target, where we bottom a couple of times. And if we lost that last, then I do see a decline towards the lows around 74.90 we have seen earlier this March. Okay, so that's what I'm looking to the upside. Um, we have some resistance around 76.50, right, and 77, as I said. Also, I told you multiple times, when the pair spikes above 77 for the last couple of years, it had quickly reversed course. So actually not expecting a bullish breakout in here. Okay, what is poised to keep advancing is gold prices, right? And it has been steadily recovering. The Fed is no longer a factor waiting on gold prices. As I told you, whatever the Fed is expected to do this year, it's already priced in. So any kind of political turmoil, it's backing gold advance, right? I'm watching this high at 1263, 1264 as a probable bullish target and level to break to see a stronger recovery. There were many relevant highs around 1283 in the past, so that's my main bullish target, 1283. If we break above this level and above it, the recovery can extend up to 1300, right? But overall, I'm not seeing much of downward potential in here. Quite bullish gold readings after breaking above its 200 simple moving average on daily, and of course, given that it's holding above its heights, despite whatever the Fed has to offer. Okay, and with gold, we have tested a couple of times right here, the 47 level, as you can see over the past couple of weeks. It's a major support, it's a critical support, and as I said earlier, I will be watching the release of US stockpile data uh, to see whether the commodity can recover a bit more or not. This is the line in the sun. If this level gives up, 45 comes outside. 45 probable bullish target, bearish target, sorry, not going to achieve it in an hour or two, but that's where the price will be probably heading. And if 45 gives up 42, 42.50. It's the next big support. It's a major long-term support. And of course, in the short term, the median resistance is around 48.70 in 5 years in here. And above that level, well, if we had some good, really good news about the market, we can retest this heights 50.12 in my charts. So that's the most I can see the commodity advancing this week. I still believe that if we reach 50, the market will be more willing to sell than to try to push the price beyond it. Okay. Okay. Pretty much that's it. So thank you all for being here, and I hope you enjoyed it, and see you back soon. Okay. Okay. There we are. Thank you, and bye bye. See you soon.